Turn off the TV. Seriously, shut it off. Whatever financial channel you have running in the background right now, mute it. Because the story they are painting for you today is not the real story. It has not been the real story all week. Since the moment this crisis exploded on February 28th, the people you trust to protect your financial future have been feeding you a version of events carefully engineered to keep you passive, keep you calm, and keep you exactly where they need you to be, doing nothing, while the foundations of the global financial system crack underneath your feet. Let me be direct with you. It is Friday, March 27th, 2026. Silver is sitting at $67.97 per ounce, and right now, the financial press is describing that price as a modest corrective bounce. A corrective bounce. That phrase is doing a lot of heavy lifting when the International Energy Agency has already described this moment as the single largest disruption to global energy supply in recorded history. Not in the last decade, not since the Gulf War. In recorded history, and they want you to think this is a blip on a candlestick chart. They are wrong, and I am going to show you exactly why. Here is what actually happened this morning while the anchors were busy fretting over a 2.4% NASDAQ drop and a Fitch downgrade on a washing machine company. Macquarie Group, one of the most respected institutional banks on earth, an Australian financial powerhouse managing over $700 billion in assets, published a research note that should have triggered emergency breaking news coverage across every major network. Their analysts, including Vikas Dwivedi, stated plainly that if the conflict between the United States, Israel, and Iran persists through June, and if the Strait of Hormuz remains closed, the world is facing $200 per barrel oil. Not $120, which is where Brent peaked earlier this month. Not $150, which is the catastrophic scenario Larry Fink floated on the BBC 2 days ago. $200 per barrel. And Macquarie did not bury that projection in a footnote with a 1% probability disclaimer. They assigned it a 40% likelihood, 4 out of 10. That is not a tail risk. That is a coin flip with the global economy as the stakes. Now here is the thing. Before I walk you through exactly what this means for silver, for gold, and for every paper asset you own, let me give you the full picture of what we are actually dealing with in the Strait of Hormuz. Because if you do not understand the geography, you cannot understand the economics. And if you do not understand the economics, you are completely blind to what is about to happen to your money. The Strait of Hormuz is 21 miles wide at its narrowest point. 21 miles. And through that channel, before February 28th, approximately 20 million barrels of crude oil and refined products moved every single day. That represents roughly 20% of all global seaborne oil trade. 1/5 of the energy that powers every factory, every transport vehicle, every power plant, every data center running artificial intelligence applications, every piece of modern economic infrastructure, all of it squeezes through a gap smaller than the English Channel. And Iran shut it down. Not symbolically, not as a warning shot. The IRGC issued military communications prohibiting vessel passage. By March 12th, 21 confirmed merchant ships had been attacked. Tanker traffic collapsed 70% in the first week, and then effectively ceased. Alternative routes through Omani ports like Duke and Salalah, the contingency plans everyone pointed to, were struck by Iranian drone and missile attacks. They are not viable alternatives. They are burning. The numbers that followed are staggering. WTI crude surged 4.6% today to $94.48. Brent is at $107.81. But those are spot prices, and spot prices only tell you what oil costs right now. The forward curve, what traders expect oil to cost 3, 4, 6 months from now, that is where the real alarm lives. Goldman Sachs has a $110 Brent forecast, Woodmac is warning diesel and jet fuel could hit $200 to $250 per barrel equivalent. And Macquarie just stamped a 40% probability on $200 crude. Rystad Energy estimates that nearly 500 million barrels of total liquids have been lost since the closure began. Roughly $50 billion worth of energy that simply disappeared from global supply chains in under a month. OECD inventories are now 180 million barrels below their 5-year average. Japan, which sources 70% of its oil through the strait, has already begun releasing strategic reserves. It will not be enough. Strategic reserves were designed to bridge short disruptions. They were not built to replace 20 million barrels per day indefinitely. Nobody's reserves were built for that. Now let me make the connection that nobody in mainstream financial media will make for you, because making it honestly forces them to admit that the price mechanism they use to value precious metals is fundamentally broken. Silver is not just a monetary metal. Silver is an energy-intensive industrial commodity. The average silver mine consumes between 15 and 25 gallons of diesel fuel per ounce of silver produced. Think about what that supply chain actually looks like. The haul trucks that are literally the size of apartment buildings running around the clock. The crushers and grinding mills and flotation circuits and smelters. The global logistics network delivering reagents, grinding media, and replacement parts to remote operations in Peru, Mexico, Bolivia, and Australia. Locations thousands of miles from any major refinery. And in most developing world mining jurisdictions, the grid power is unreliable or non-existent. So mines generate their own electricity using diesel generators. Every step of that process, from the first blast hole drilled in the rock to the final stamp on a refined 1,000-ounce bar, runs on hydrocarbons. Let me run the math live so you can see exactly what $200 oil does to this industry. The all-in sustaining cost for the average primary silver mine globally sits around $22 to $26 per ounce at normal energy prices. Energy represents between 20% and 35% of those costs, depending on jurisdiction and mine type. Taking a midpoint of 27%, you get approximately $6.48 per ounce, attributable directly to energy at baseline oil prices of around $65 per barrel. Now, when oil doubles from $65 to $130, that energy component does not simply double. It cascades. Diesel refining margins expand during supply crunches. Transportation costs for the diesel itself increase. Every input that requires energy to manufacture, steel, rubber, explosives, reagents, lime, all of it inflates simultaneously. A reasonable cascade multiplier during a sustained oil shock is 1.5 to 2 times the crude price increase. So, if crude doubles, mining energy costs can triple. That $6.48 per ounce becomes roughly $19.44. Your all-in sustaining cost jumps from $24 to $37 per ounce. That is at $130 oil. At $200 oil, you are looking at all-in sustaining costs of $45 to $50 per ounce for the average mine. For high-cost producers in Bolivia or Argentina, where infrastructure is poor and diesel has to be trucked hundreds of kilometers, you could be looking at $60, $70, possibly $80 per ounce. The paper price of silver today is $67.97. Do you understand the implication? At $200 oil, a substantial portion of the global silver mining industry cannot operate at a profit at current quoted prices. They will curtail production. They will place mines into care and maintenance. No CEO authorizes running a mine at a sustained loss, especially when the cost of the energy alone approaches or exceeds the market value of the metal being extracted. And when those mines go dark, the silver that was supposed to come out of the ground next quarter, the silver earmarked for solar panel manufacturers, for electric vehicle battery systems, for semiconductor fabrication, for defense applications requiring silver-palladium contacts, that silver simply does not exist. You cannot substitute for it. You cannot conjure it with monetary policy. Silver requires energy to produce, and energy just became a weapon of war. Now let me walk you into the COMEX, because this is where the real crime is being committed in daylight, and most people watching financial news have no idea it is happening. COMEX is the commodity exchange, a division of CME Group, and it operates the dominant paper silver market globally. When you see silver quoted on any financial platform, that number is derived from COMEX futures contracts. Each contract represents 5,000 troy ounces of silver. The critical detail that rarely gets discussed is that the vast majority of these contracts never result in physical delivery. They settle in cash. They roll forward month to month. They are pure paper instruments, allowing banks, hedge funds, and algorithmic trading operations to set the price of a physical commodity without ever touching a single real ounce. This creates what is effectively a fractional reserve system for metal. The same bar of silver sitting in a COMEX vault in Delaware can theoretically underpin multiple simultaneous paper claims, because the system assumes those claims will never all be exercised at once. That assumption is now failing. COMEX registered silver inventory, the metal actually earmarked and available for physical delivery, the bars with warrants attached that can legally be handed to someone demanding settlement, dropped below 90 million ounces for the first time in recent history. As of late February, the figure stood at 88.191 million ounces, reflecting a 32% decline in just 4 months. Total COMEX silver inventory, registered plus eligible combined, has fallen 31% from 532 million ounces in October to approximately 366 million ounces today. And the coverage ratio, the fraction of outstanding paper claims that could theoretically be satisfied with real deliverable metal, sits at approximately 13.5%. That means for every 100 ounces of silver the paper market claims to control, only 13.5 ounces actually exist in deliverable form. The leverage ratio is 7.4 to 1. 7.5 paper promises for every single real ounce. And here is why the timing matters critically. April 2026, first notice day on the COMEX, is 2 business days away. As of today, 1,981 contracts remain open in the April silver delivery month. That is 9.9 million ounces of potential delivery demand against a registered inventory of 88 million ounces that has been draining at an accelerating pace. This is not a routine delivery cycle. December 2025 saw 46.6 million ounces delivered, representing roughly 50% of estimated free float registered inventory in a single month. January 2026 saw delivery demand of 33 to 49 million ounces in the first 2 weeks alone, which was 7 to 10 times the historical January average. The system is under stress it was never designed to absorb, and the metal is not staying put. Physical silver is migrating. It is moving to London, where lease rates spiked to 35% last October, a number that signals acute physical shortage, not routine market activity. It is moving to Shanghai, where the Shanghai Gold Exchange has been consistently trading at premiums of $10 or more above Western spot prices. The East is systematically draining Western vaults, and the oil shock is about to accelerate that drain into what I would describe as a full-blown liquidity cascade. A liquidity cascade is what happens when a market that depends on the continuous availability of a physical commodity suddenly confronts the reality that the commodity is not there. Think of the COMEX paper market as a river flowing smoothly because every participant assumes physical metal can always be sourced when needed. The moment that assumption breaks, the moment enough market participants start questioning whether the metal actually exists, the flow reverses. Everyone's short. Every institution that sold a paper promise to deliver silver they do not actually hold scramble simultaneously to cover their exposure. And there is not enough metal to cover. That is when you get a gamma flip, when every market maker who was selling into rallies to cap prices suddenly has to buy into rallies to maintain hedging obligations. Selling pressure inverts into buying pressure overnight. Prices do not trend higher. They gap. They leap vertically in what traders call a V-shock. A move so sudden and so large that the chart literally forms the letter V because there are no bids between the old price and the new one. The market closes at $68 and opens at $110 because every algorithm fired simultaneously. That is not speculation. That is the documented behavior of paper markets when physical scarcity becomes undeniable. And this is exactly what institutional money already understands. When you see silver ticking up on a Friday, while the mainstream narrative is focused on tech stocks and credit rating actions, what you are observing is not retail sentiment. The energy desks and commodities desks at major banks, the people who actually understand physical supply chains, are telling their portfolio managers that $200 oil means silver mines close. And if silver mines close while industrial demand is running at a structural deficit of over 200 million ounces per year, which it has for 3 consecutive years, then there is simply not enough silver for solar manufacturing, for electric vehicle production, for AI server infrastructure, for defense systems, for medical devices. The green energy transition, which requires silver in quantities that dwarf any other industrial metal per unit of energy output, stalls, and the price has to rise to ration whatever physical supply remains. Let me give you the geopolitical layer that ties all of this together. Because what is unfolding in the Strait of Hormuz is not just an energy story or a silver story. It is the story of the dollar-denominated global financial order cracking under pressure it was never designed to withstand. The dollar's reserve currency status rests on 2 pillars. First, the capacity to project military power globally to enforce dollar-denominated trade flows. Second, the willingness of the rest of the world to continue accepting dollars in exchange for real goods and real energy. Both pillars are fracturing simultaneously. The military projection failed. Strikes on Iran on February 28th provoked the precise economic retaliation most calculated to damage the West, closing the world's most critical energy choke point. 4 weeks later, the strait remains closed. And on the second pillar, consider what Iran's foreign minister announced on March 26th. Ships from China, Russia, India, Iraq, and Pakistan would be permitted to transit the strait. Western-aligned shipping remains blocked. It is actively creating a preferential trade architecture that advantages BRICS-aligned nations at the direct expense of dollar system participants. China is receiving preferred access to Middle Eastern oil, while the United States prosecutes a war, driving that oil toward prices that will devastate American consumers and American businesses. The infrastructure for exactly this bifurcation has been under construction for years. The M-Bridge system, the cross-border central bank digital currency platform developed through the Bank for International Settlements, with the People's Bank of China, the UAE Central Bank, the Bank of Thailand, and the Saudi Central Bank, was explicitly designed to facilitate trade settlement outside the SWIFT dollar framework. Basel III and Basel IV regulatory reforms reclassified physical gold as a Tier 1 reserve asset, equivalent in regulatory treatment to U.S. Treasury bonds, meaning central banks can hold gold as risk-free collateral, and they are doing it at record levels. Central bank gold purchases hit historic highs in both 2024 and 2025. Gold touched $5,589 per ounce in January, an all-time record, before a Fed-driven correction pulled it back. Even after a 21% pullback, gold is trading at $4,430 today. The central banks of the world are voting with their balance sheets, not their press releases, that the dollar's structural role is diminishing. And silver, currently trading at a 65-to-1 ratio against gold, remains the most undervalued asset in the entire monetary complex, because unlike gold, silver gets consumed. It disappears into photovoltaic cells, into circuit boards, into surgical tools, into missile guidance systems. You cannot recover it without mining more, and you cannot mine more without oil. And the oil is sitting behind a military blockade in the Persian Gulf. Let me close by giving you the historical context that makes this moment impossible to dismiss. In 1973, the OPEC oil embargo removed approximately 4.3 million barrels per day from the global market. Oil prices quadrupled. The United States fell into recession. Inflation went double-digit. The stock market shed over 45% of its value in real terms. That disruption was 4.3 million barrels per day. The current crisis has removed 17.8 million barrels per day, more than 4 times the 1973 shock. In 1979, the Iranian Revolution removed roughly 5.6 million barrels per day. Oil went from $14 to $39. U.S. inflation hit 14.8%. Paul Volcker was forced to push the federal funds rate to 20%, collapsing the housing market and triggering the worst economic contraction since the Great Depression. That was 5.6 million barrels per day. We are at more than 3 times that scale. In 2008, oil reached $147 per barrel during the speculative run that preceded the global financial crisis. Lehman Brothers disappeared overnight. AIG required $182 billion in government support. The S&P 500 lost 57% of its value. The overnight repo market, the plumbing that keeps the entire financial system liquid, froze because counterparties stopped trusting each other's collateral. And the initial shock was energy at 147, not 200. Macquarie is giving 200 a 40% probability. We are entering this moment with COMEX silver inventory at historic lows, a 7.4 to 1 paper leverage ratio, central banks hoarding gold at record pace, and the Federal Reserve completely trapped. The Fed cannot cut rates to support economic growth without pouring fuel on the inflation fire that $94 oil is already feeding. And it cannot raise rates without triggering a debt spiral on $36 trillion of national debt that requires continuous refinancing at higher and higher yields. The Fed acknowledged this bind explicitly. At the last FOMC meeting, they revised 2026 rate cut projections from 2 cuts to 1, citing February PPI at plus 0.7%, well above consensus, and explicitly identified the Strait of Hormuz oil spike as creating the kind of inflation persistence that prevents monetary easing. They admitted it on the record. And yet silver, simultaneously a monetary hedge against dollar debasement, an industrial input being consumed faster than it is produced, and a physical commodity that requires the very energy being cut off to extract, is trading at $67. It was at $83 just weeks before the CME raised margin requirements. That margin hike was not a neutral regulatory adjustment. It was the same playbook used in May 2011, when margins were raised 5 times in 9 days to drive silver from $49 to $32. It is the same playbook used against the Hunt brothers in 1980, when the exchange switched to liquidation-only trading to prevent new long positions. When the paper short position becomes untenable, the rules change. The price craters. The media calls it a correction, and everyone goes back to sleep. Except this time, the physical metal is not returning to the vaults. This time, the drain is structural. This time, Iran has a military blockade on the energy required to replace what is leaving. The correction has a ceiling that the physical reality will not allow it to hold indefinitely. Whether the break comes in April, when delivery notices land, or in May, when mining companies begin reporting catastrophic cost overruns, or in June, when Macquarie's $200 oil scenario materializes, the math points one direction. Silver requires approximately 360 megajoules of energy to produce 1 kilogram of refined metal. That energy has to come from somewhere, and somewhere is currently closed. Hold your mettle. Hold your ground. The archive does not sleep. John A.G. will see you this weekend.